Hello everyone, my name is Naledi and today we will be looking at intergroup transaction where we have an associate. Now remember, for purposes of consolidation, when you have an associate, you take 100% of the parent, but you only take from an associate share of profit in associate as well as investment. So that's why the elimination of intergroup transaction depends on whether the parent is the one buying from the associate or the parent is the one selling to the associate. In this case, we have the parent selling to the associate inventory. So from the perspective of the associate, we eliminate the profit because the associate is the one making the profit. We eliminate it via cost of sales and sale. Now the associate is the one that has the inventory, but because we only take investment, that's why we represent the inventory through investment. Because for purposes of consolidation from the statement of financial position, we only have investment from associate and not the inventory, so we cannot eliminate the inventory. In the subsequent year, what happens is that all the gain from this disposal goes to the profit or loss, the retained earnings rather. So that's why we have to eliminate retained earnings, and then we realize the gain by crediting sales and debiting cost of sales. And the taxation from the previous year is also realized. When we have a situation where the parent is selling an item of PPE to the associate, the parent is the one that's making the profit, so we eliminate the profit. The associate is getting the asset, but because in our statement of financial position, when we consolidate, we only have investment from associate, what we do is we will eliminate the investment. Now we have to realize the profit over the useful life of the PPE. So what we do is we credit the depreciation and then we debit investment, because essentially that debited investment represent accumulated depreciation. But because we only have investment from the statement of financial position, we will debit investment. The taxation journals are the same as if you had control. Now in the subsequent year, we eliminate retained earnings. I just want to say the journals that has investment debited and investment credited, you can just make it one journal entry by debiting investment. That portion represents the unrealized gain that will be realized in the future. And then in the current year again, you realize the depreciation, you realize the gain through depreciation and investment. Now in the situation where the associate is the one selling to the parent, the associate is the one making the profit, but for purposes of consolidation, in our statement of profit or loss, we have share of profit from associate. That's why we then debit the share of profit from associate and then we credit the inventory. And then again, since the associate is the one selling and therefore the one making the profit, he will be the one who's taxed. That's why we don't have income tax, but rather profit from associate. Subsequent year, the retain will have to eliminate the gain through retained earnings, and then we debit the deferred tax and then we credit share of profit from associate. Now where the associate is now the one selling an item of PPE to the parent, the associate is the one making the profit. So the only line item we have in the statement of profit or loss when we consolidate is share of profit in associate. That's why we eliminate that. The parent is the one having the item of equipment. Since when we consolidate, we take 100% of the parent, we will have to eliminate the equipment. And then again, we realize the gain every year over the useful life of the asset. We will then debit the accumulated depreciation and credit share of profit from associate. In the next year, we do all those journal entries. If you need more information on this, please contact me. Thank you.